Physicians and Properties webinar with my good friend Raj. Today we're going to talk all about multifamily investing in 2023 and talk a little bit more about if that makes sense. Raj is my good friend here. He's a world-renowned pediatric cancer researcher, oncologist, real estate investor, entrepreneur, founder and manager of REI.capital. They in total, as a general partner or limited partner, own more than 10 properties, totaling more than 1,700 doors. Raj has a ton of experience that he's willing to share with us tonight. So we'll go ahead and get started. Raj, thanks for joining us. Thank you for your time.
Oh, thank you so much, Alex, for inviting me for this. I'm part of your Facebook group, and I see all the amazing things you're doing, and your group is exploding. And I'm glad to be part of your group and contribute what I can. So the topic I wanted to talk about today is, does multifamily investing make sense in 2023? So this is a common question among real estate investors, right? So multifamily was hot in the last 5 years, and suddenly people are asking, hey, does it still make sense to invest? We are hearing all kinds of things from the news. So what's real, what's not real? So that's what we're going to talk about. And a lot of your listeners or viewers and your group people are very well versed in real estate, but I still want to give some basic introduction. This is going to be the outline. We're going to talk about multifamily basics, and then also going to look back on the multifamily performance in the last 5 years. And then I'll give you some brief overview of current macroeconomic environment and how it is affecting multifamily. And then what kind of opportunities are there in 2023 if you want to invest in multifamily. Before I start, I just want to give an important disclaimer. This is just for education. REI Capital or myself, we are not legal, financial, or tax advisory firm. Please consult with a legal, financial, or tax professional for all legal, financial, or tax related questions. So majority of my perspective is going to be talk like a limited partner who has invested in multiple syndications. So Alex gave an excellent introduction. So I'm an academic pediatric oncologist. I'm based out of Houston, Texas. I'm a tenured professor. Basically, I've published a lot of manuscripts, book chapters, those kinds of things. I hold national leadership roles in pediatric cancer. Also, I have a master's from University of Southern California and an MBA from University of Massachusetts. In real estate, I've invested in about 10 plus properties, 1,700 plus doors so far, both as a limited and partner and a general partner. I'm the founder of REI Capital, a boutique investment firm focused on helping doctors invest in apartments. So what is multifamily anyway? Most people, when they start investing, they're going to invest in a property like this on the screen, which is a single family home where one family lives, right? Multifamily is a property where more than one family live. It can be a small multifamily like a duplex, triplex, or fourplex, or a large apartment complex like the one on the right. Today's talk is primarily going to focus on large complexes. But if you want to invest or buy a large apartment complex, most of us don't have millions of dollars sitting around to buy these, right? So that's where what we call as real estate syndication comes in. Here, a group of people can pool their resources and expertise together and buy these large properties. This gives you some unique advantages because of the scale, which we'll see in a minute. So most people understand single-family rental. You buy the property, put a tenant in, they give you money to pay off your mortgage. Whatever is left is cash flow. But what happens, where do the returns come from when you invest in large apartments? It's similar to single family, where first is rental income. When the tenant pays rent, you get some cash flow. The second is appreciation, which when you sell the apartment, whatever profit we make, this is called as appreciation. And rental income, you understand very well. I'm not going to go into it right now. But when you talk about appreciation, there are two kinds of price appreciation in multifamily. One is natural appreciation, and the other is called as forced appreciation. Natural appreciation is the value of the real estate tends to increase over time, right? You do nothing, the real estate keeps going up, except if in this graph you see a small dip after the 2008 crisis, but it still continued along the path, and the real estate value, this graph is basically single family home value graph, but it applies to multifamily as well. And these increased natural appreciation keeps pace with inflation. So when the inflation rates are high, the value goes up faster as well. And when you operate a multifamily apartment, you don't have any control over natural appreciation. We don't get to determine how much it appreciates, right? So there is no control over this one, and it's determined by external factors. But what we can control is where we buy these apartment complexes, right? If you buy the complexes in places where population is increasing, jobs are increasing, and people are moving into, then you'll make sure there is always demand for these apartments, and there is always be a natural appreciation rate will be higher than other places. So for us, the primary markets where this happens is Texas and Southeast. That's where people are moving into. That's where jobs are increasing. So we think it's going to be very strong in these markets, the natural appreciation in the next few years. The second one is called as forced appreciation. So we talked about natural appreciation. Other way you can increase the value of the apartment, make more profit, is you can force the appreciation. What do we mean by that? So in order to understand that, you need to know how an apartment is valued, right? So the value of the apartment is directly linked to the net operating income over cap rate. So this is basically, that's how we determine how much to pay for an apartment. Net operating income is very simple. It's a total income minus expenses. It excludes a mortgage payment. So say we make $100,000 and then we have $50,000 in expenses that day. Our net operating income is $50,000 for that year. This one we can control, something we can control and change, right? So we can either increase the gross income by improving the apartment, or we can decrease the expenses. Expenses is technically the money we pay for personnel, pay for electricity, for water. So we can do both. We can try to increase the gross income, or we can try to decrease the expenses so that we can increase the NOI and increase the value of the apartment. So here, I'm going to show you an example of forced appreciation, right? One on the left is a non-rehabbed unit. Say this unit commands a rent of $800. When we buy an apartment, we go in and then we do improvements. Here you can see on the right side, the kitchen is improved, the cupboards are improved, and we can also improve the bathrooms, put new tiles and etc. And we often are able to increase the rent on the left side, $800 to $900 or $1,000, right? That may not sound like much, but when you actually look at the net operating income, it's going to increase it significantly. Say, for example, we buy a 100-unit apartment, right? And then we spend $10,000 per unit and rehab the bathrooms and kitchen and everything, and we increase the rent by $200 per month per unit. Right? If you look at it, you get, for 100 units, you're going to get $20,000 per month more in rent, and over 12 months, you're going to get $240,000 more in rent. So this is going to increase our cash flow by hopefully $240,000, but also it's going to increase the value of the apartment. I'm going to show you how in the next slide. Say I showed you a formula in the beginning. The value of the apartment is directly related to net operating income divided by cap rate, right? Say we increase the net operating income by $240,000, and say a standard cap rate of 5%. So it's $240,000 by 5%. The actual value of the apartment goes up by $4.8 million. If I go back, we spent about $1 million, right? $10,000 per unit, and increased each unit's rent by $200 per month. But you have actually, for the $1 million input, you're getting $4.8 million output. So it's like four or five times the money you put in, you can get out. So that's how we force appreciation of the apartment. And this is one of the major benefits of investing in apartments. So that gives you a brief overview of how what multifamily investing is, how we increase value, how we make profit in a multifamily. Now we can look at what happened in the last 4 or 5 years in the multifamily space. First question I ask is, how many of you have invested in multifamily between 2017 and 2020? I was one of those investors. If you had invested, you probably did very well, right? But why was that? If you had to summarize what happened in the last 5 years, this sentence would be very apt. Rising tide lifts all boats. It did not matter who steered the boat, what condition the boat was, all the boats did very well. So you can replace the boats with multifamily. So it didn't matter what kind of multifamily you invested in between 2017 and 2020, you did very well. You made a lot of money. But why is that? Reason number one, there was an astronomical increase in rents during COVID. Right? This graph shows the US average increase in rent over 4 years. It was 30%. We see the middle for the United States, there was a 30% increase in rent from 2019 to 2023 as an average across the United States. But some markets are even hotter than that. For example, Tampa, St. Petersburg on the right side, if you see that rent increased by 60%, right? If it was $1,000, it went to $1,600 in just 4 years. So apartment operators didn't have to do anything. That when the rent goes up, their net operating income goes up, then the value of the apartment goes up. So you can sit on your hand and make a lot of money during this period. The second reason was, of course, we all know government printed a lot of money. Right? People had lots of money and they wanted to invest somewhere. The apartment was hot because the rents were going up. So everyone was rushing to invest in apartments. So the cap rate, which is basically how much people are willing to pay for an apartment, they actually are willing to pay more for apartments. The cap rate actually went down. If you see the graphs here, this is the average cap rate in primary, secondary, and tertiary markets. Primary market is Houston. All the metros are primary. Slightly smaller towns are secondary, and then really small towns are tertiary. So in all of those markets, people are willing to pay more and more for these apartments for a given return. So why does it matter? So for example, if the cap rate decreases from 5 to 4, right, the apartment's value actually increases by 25%. Say you bought an apartment in 2021, January, at $10 million. By December, the cap rate went from 5 to 4. The value of the apartment was $12.5 million. You didn't have to do anything, right? So you just sit on it, just collect rent, and you made $2.5 million profit just because of the cap rate decrease. So going back, in the last 5 years, the net operating income went up significantly because the rents went up, and the cap rate went down because people are willing to more and more invest in apartments. So because of those two things, the value of apartments shot up. Then, so everyone was enjoying these high returns, and then this happened. Of course, the inflation first shot through the roof. And in response, Fed started increasing interest rate at an unprecedented rate, right? So they started increasing every month, every 2 months, a lot of increase in interest rate. At the same time, they also winded down their quantitative easing. So debt cost more, and payment for people with variable interest rate. A lot of these apartments are bought with variable interest rate, and that mortgage payment started going up. Some of them got it at 3.5% interest rate. Suddenly it becomes 7%. So if they're paying $50,000 for interest, now they're paying $100,000 per month as interest. That's a significant increase in their expenses every month. So this graph actually shows the interest rate since 2000. If you look at the whole graph, the current interest rate is not the highest interest rate ever. But the problem is, if you see the acuity of increase in interest rate, it went from 2022, suddenly it starts going straight up. That has been the problem. The market didn't have time to adjust to this higher rate, and the rates kept going up, and mortgage interest rate kept going up, and a lot of people got into trouble. So this is what I would describe the current scenario, what multifamily investing is like. So only when the tide goes out do you discover who has been swimming naked, right? So a lot of people are finding themselves in trouble right now because they haven't prepared for this increased interest rate. So if you don't understand, one of the concepts you need to understand is market cycle in real estate. So this applies to single family or commercial real estate. This cycle, if you understand where we are at the cycle, you can make informed decisions about investing. If you start at the left, the first phase is a recovery phase. Say you are coming out of recession, say 2008 recession, right? First thing which happens is the occupancy in the apartment starts increasing. So if it is 90% occupied, suddenly it's 95% occupied. So when the occupancy goes up, everyone sees, oh my God, now the demand is back. Then people start constructing new apartments or new single family homes, those kinds of things. So there's an expansion phase after the recovery phase. And then people overshoot, right? Everyone wants to construct new things, want to make money. They often overshoot. There is often a hyper supply of individual homes or apartment complexes. So when you're hyper supply, your occupancy goes down, right? And then after some time, the hyper supply doesn't go like decrease, and then we go into recession. So the real estate goes through these cycles: recession, recovery, expansion, hyper supply, then goes back to recession. But after 2008, we had a prolonged period of expansion. Now we are in the hyper supply recession area, right? And of course, you've probably seen these foreclosures in Houston. $228 million worth of property foreclosed by an multifamily operator. It's 4 different properties. And this is all over the social media, in Wall Street Journal. Of course, some of our physician colleagues also put it on saying, hey, don't invest in apartments. Those are not real good investments. All these things are going to go down. But one thing to understand here is there are inherent issues with this specific operator. They basically, they were not very experienced, and they didn't have a good team. There was like one guy collecting all this money, mainly from immigrants from India. And these were Class D properties, and they marked as Class C. Class D is like the lowest level properties, and they didn't do a rehab, they didn't do business plan, those kinds of things. So that greatly contributed to them going under. That doesn't mean other apartment complexes are not going to go under, but this one actually had other issues other than just multifamily fundamentals. So what's happening in the market as a result of Fed's action plus this natural real estate cycle I'm talking about? So right now, rent growth has actually slowed down. That's for sure happened across the board, across the country. During COVID, the rent was increasing 10%, 15% per year, which is unheard of before. The natural increase is about 4%, 3 to 4%. Now it's going back to more natural increase in rent every year. And some markets have not increased, have remained flat, or some actually have gone down. Like Phoenix, there is a hyper supply, and then some of the rents have actually gone down in Phoenix because people want to fill their apartments, so they decrease the rent to attract more tenants. And this is also across all classes: Class A, Class B, Class C. All classes of apartments, the rent growth has slowed down. And you remember the graph I showed you in the beginning, where across the years it increased by 30%. Some markets it increased 60%. This is the current 2023 thing. When compared to the pandemic period average, the rents are definitely not increasing as much. Here, the negative value doesn't mean the rent is going down, but it's not increasing as much as it used to do. So what's happening to the operators of the apartment? We have to do a better job to capture that increased rent. So we have to do more value add, rehab more units. During COVID, when the rents were going up, a lot of people didn't even rehab the unit. They just let the unit sit, enjoy the increase in price. Now we have to do the work to get more rent from tenants. And also, that's the net operating income is not going up because the rent is not going up, so the net operating income is not going up that much. But also the other end of the puzzle is the cap rate, how much people are willing to pay for apartments. That has actually gone down as well across the market. So, for example, here I'm showing you one example. In Phoenix, the cap rates increased about 1 to 1.5%, right? Before it was like 3 to 3.5, now it's 5% to 5.5, 5.25. What it actually means is it decreased the value of the apartment by 25%. I told you before, when the cap rate decreases, you don't have to do anything and you make a lot of profit. But when the cap rate increases, then you're not going to get the same price for the apartment as before. So what is the net result? I told you NOI is going down, cap rate is going up. So the value of the apartment is going down overall. So that should not matter if you're not going to sell the apartment this year, right? There's a natural cycle. If you hold it long enough, the cap rate is going to compress, NOI is going to increase, those kinds of things. But if someone has to sell the apartment this year, 2023, or if they have to refinance the apartment this year, right? Sometimes they get a 2-year, 3-year loan and they have to refinance. Now they got the loan for 3%. Now it's 8.5%. When they refinance, it doesn't make any sense. It's not sustainable. So that's why you can get into trouble if you want to either sell the apartment this year or refinance this year. You're not going to get the same projections you had previously. So what to expect in the rest of 2023, 2024? I'll summarize this in one sentence here. So low tide will reveal some hidden treasures. So there are some opportunities out there which we can use if you have enough cash sitting around. For example, Blackstone recently raised more than $30 billion for the giant real estate fund this year. So why are they doing this when the market is not doing very well? Because they know that there are a lot of opportunities coming in the market. They're basically waiting to scoop up a lot of properties this year. So the situation is not all bad. I did say that the apartment values have gone down, but it's not that all, because overall market fundamentals are still strong. So even though I said the vacancy rates are raising, right? It was like 98, 99, people could not find any apartment unit. Now it's like 95 to 93% occupancy. But even though they decrease, they are along the historical average. That is the historical average for apartment occupancy. The other trend is people are getting married, but they're not buying their houses immediately. The first home, they're delaying the purchase of the first home. That means that during the time after marriage, they're staying in apartments. So there is a strong economic fundamental towards apartments. So the other thing is, even though home prices have fallen a little bit this year, they're still very high. This is for single family homes. So if someone wants to buy a home versus renting, there is still a huge gap. So renting is more affordable in majority of places in US when compared to buying a house. So that again goes in favor of multifamily. So the average difference between buying a home versus renting is almost $1,000 in most places in the country. This is per month expense. And then the other thing I talked about is a lot of apartments are coming in, new supply coming in. But even though a lot of new apartments are being built, they're just keeping up with population growth in many places. For example, in Houston and Dallas, they're just able to keep up with population growth. So in this graph, the size of the circle represents how many new apartment buildings are being built, and the color represents how fast the population is growing. So if it is green color, that means the population is growing very fast, and the circle is big, that means that the more apartments are coming into that market. And this is the prediction from CBRE. CBRE is a well-respected firm, it's a brokerage firm, and they're predicting for the next 2023-2024, the number one or the best ones, here the lower number is better. Industrial and multifamily are the best sectors which are going to perform when compared to retail, hotel, and office. So that is their prediction at least. Of course, it's just a prediction. So to summarize, why multifamily in 2023? This is why multifamily still makes sense. One is the rent usually keeps up with inflation, right? The renting is still more affordable than buying a home in many markets. And then there is a huge opportunity for us to buy apartments at discounted pricing when people are not able to refinance, people are not able to sell, they're going under, then you can get good deals on these apartments. This is just one prediction. This is from Marcus and Millichap. Their survey, top 10 markets for multifamily. Majority of them, if you can see, are in Florida and Texas, and then some of them in Charlotte, etc. This was the prediction, but what we are also seeing is a lot of the Midwestern markets, a lot of South and Southeast, the rent is not going up that much, but Midwest, which usually is very steady, the rents are doing very well this year when compared to all the other regions in the country. So we looked at what multifamily is, how did it do last 5 years, how is it doing now, and we are predicting what's going to happen in future. But in this situation as an investor, how do you decide which deal to invest, right? You get bombarded with, hey, this is the best deal, this is a good deal. Everyone says we have underwritten conservatively. This is the worst case, and even in worst case scenario, we make money. So how do you decide which deal you want to invest? So I had the same question. This is the most common question people ask. So we came up with a website called passiveinvestingchecklist.com. So I highly recommend you check out this website where you can have a checklist. I'm going to show you a little demo of it here. Hopefully you're able to see this website. 1 minute, let me pull it up. So Alex, are you able to see this one? The web page? Yeah, okay. So if you go to passiveinvestingchecklist.com, you can actually download the free free checklist. It's a PDF, but you can also fill it online. So you're going to say you want to invest in some new deal which is coming up. You need to first know what question to ask for a sponsor. They come and say, hey, this is a good deal. and you can invest in my deal. So you need to know what question to ask, right? So I'm going to go over some of it, a brief, quick overview. Let's say you can go here and type whatever the property name is, city, state, zip code. Only thing which you need to type is the property name. Otherwise, you can skip those. And then the first thing I always look at is the sponsor, right? People have a tendency when they have a new deal to look at, hey, how much money I'm making. So that's not the way to look at it. First thing I always look at is sponsor. The second is the market, and third is the deal. That's the way you have to look at it. A lot of people look at the deal first, then the market, then the sponsor, but it should be the other way around. The first thing you have to ask is, hey, do I trust the sponsor? Do they have a good team in place? What is their track record? Are they putting some money themselves into the property, right? If they think it's a very good deal, they should be putting their own money into the property. And then how many deals have they done? How many deals they have taken through full cycle? Full cycle means they bought it, they operated it, and they sold it for a profit. How many of them? What is their track record? How many did they do? So that's how you look at the sponsor. Next thing you look at is market, right? So is the market primary, secondary, or tertiary market? Primary means the large metros. So in this environment, I'm actually looking just at primary market, maybe some secondary market, definitely not a tertiary market, because in general, tertiary markets tend to be higher risk, but it's not always the case. And then we also, when you look at the market overall, we want to see there should be a good population growth. In this checklist, you'll have links to all these places where you can get the actual data. And then what is the median home value in that area? And how much has it increased since 2000? What that indicates is it gives an indication of natural appreciation in that area and how your apartment is going to do. Of course, you also always have to look at the crime rate. Is the crime rate high in that market? Then your property value is not going to go up that much. And you can also look at the sub-market, the individual county, locality the property is in. So what is the poverty level in that area? What is the median household income? In general, it has to be at least 3 times your early gross rent, right? What is the unemployment rate? We don't want unemployment rate to be high. Then the tenants won't be able to pay you the monthly rent. And then you also want it to be very diverse, demographically, industry-wise. Employers should be diverse. It should not be dependent on one industry. If that industry goes down, then your apartment value will go down significantly. And the things I always look at is, if it is a class A, I look at where is the nearest Starbucks is. If the Starbucks is in walking distance, then you know that it's a good area, because Starbucks has already done all the research for you, and they have found all the good areas in the country. So you don't have to struggle, right? If it is a class B, then I look at like Walmart. Class C means is there a dollar store nearby? So it depends on the class of the apartment. But if there is a Starbucks or a grocery store in walking distance, then it's always a good sign. Then you look at the actual property itself. In general, we go for greater than 100 unit properties because it gives you economies of scale. You can have in-house on-site person for maintenance, on-site leasing agent, those kinds of things. We also look at the property price per door. How much are we paying? Say if there's a single family home, next door is $200,000. And if you're paying for an apartment, each unit $230,000, it doesn't make sense. Because why would someone come here? They would just go and buy the single family home. Right? So you have to look at the other areas and what the price per door you're paying. And what is the class of the property? I just alluded to class A means the best quality. Class B a little bit lower. Class C is basically a working class, blue collar apartment complex. And also the neighborhood class. And then we always look at the current occupancy. If there are 100 units, at least 90 units should be occupied. That means it's not a distressed property. Often what happens is 95 units may be occupied, but only 85 units may be paying the rent. So that's called economic occupancy. So you have to look at both physical occupancy and also the economic occupancy of the apartment as well. So these are the things you generally go through when you're going to invest. And if you don't know any of these things, you just ask the sponsor, hey, what is your current occupancy? What is the economic occupancy? What class is that? So they should be able to give you all this information. And then once you fill this whole checklist, you'll actually receive a summary in your email so you can go through it. And if you have 2-3 properties you're looking at, you can fill the checklist or 2-3 properties and compare them at the same time. And then if you see here, the projected returns is coming like 5th or 6th page in my checklist. So it's not the first thing you look at. Projected returns should come later, right? The reason is it's a projected return. It depends on all the other things I talked about. The sponsor can tell you, I will give you 25% IRR. but it may not happen, right? It's just manipulating some numbers in an Excel file to get to the actual return you want. So you have to do your own due diligence instead of what they tell you. So you always look at cash on cash returns. If you go here, I also put videos here so you can actually know, hey, what is cash on cash return? You can actually go and watch a video. Internal rate of return, equity multiple. Most physicians, they're looking at equity multiple. We are not dependent on cash because we are not retiring tomorrow. So we want to improve our wealth. So we are looking at, hey, in 5 years, I'm able to double my investment. How much my equity is increasing. But that's important. But also you want to make sure there is a cash on cash return. Never go for an apartment where there is no cash on cash return because you want positive cash flow happening all the time. That decreases your risk. Okay. So those are the things to look at. And then also financing, this may be too complicated for some people, but you need to know what type of loan they're getting. Is it agency loan, bank loan, bridge loan? Bridge loan tends to be higher risk usually because it's higher leverage. And then what is the loan to value ratio? The higher the loan to value, say if they're financing 80% of the purchase price, that's a higher risk than financing 60% of the purchase price. So of course, if you finance 80% of the purchase price, you can make more profits, but also at the same time, it's a higher risk. So you have to look at those things as well. And then the last thing is, we also ask the dealer, what are you assuming? What is your assumption? So what cap rate are you purchasing? And what do you think the cap rate is going to be when you sell? So they're purchasing at 5 cap and they're saying, hey, it's going to be 4 cap when I sell. That's not a good deal. It's always should be higher than the cap rate they're purchasing, right? And how much rent increase are you projecting? These are questions you're going to ask the sponsor. They say, hey, right now the rent is $1,000. 5 years from now, I'll get $2,000 rent. It's not a very feasible approach. So how much are you increasing the projected rent every year? So you have to ask that question. And then the last thing you look at is also, do they have a preferred return? So you can watch a video for what the preferred return is. How are they splitting the profits between LP and GP? Right? So the general partners who put the apartment together, they make money by splitting the profits with you. So how much are they splitting? Are their incentives aligned with your incentives? How much is the asset management fee? How much is the acquisition? What is the various kinds of fees they are charging? Are they primarily dependent on the fees to feed themselves? Then they may not care about the eventual result. If the fees is the main aim for the GP, then they may be reckless and doing more and more deals to get more and more fees. So you have to look at the fees they charge should be reasonable. And then, of course, you have to ask, what is your business plan? How are you going to increase the value? How are you going to increase the NOI? Have you done this before? So those are the questions you ask. So you can go through these question by question and ask this question with the sponsor as well. And then the last thing is checklist I put in specifically for you is, what is it, after you do all these things, what is your gut feeling, right? So all the numbers may make sense, but you think, oh, something is not right about this deal, then don't invest. There are hundreds of deals out there. Every time someone comes and presents you a deal, they're going to tell you, hey, this is the best deal. You're going to miss out. It's 90% filled, 95% filled. Hey, there is 2 spots left, right? There will always be another deal. So that's what I tell my investors, right? I never tell them, hey, come in by tomorrow, otherwise going to miss out. If you feel good about this deal, invest. Otherwise, there will always be another deal, right? So there's not like deals are going to run out and you have to get in right now. So always trust your gut feeling. If you don't feel like you should invest, don't invest. And you also need to know how much you can invest, what is your source of funds, those kinds of things. So this is the general thing. When you go and fill this out, and then the whole thing you filled out will be emailed to you as a summary document. You can either use it online or you can just download the PDF from here as well. So that is the general idea of things. And I also have this tool that I'm testing. So if you're here, you can actually text hello Raj to this number. Then I will email you the actual PDF checklist. You don't even have to go into my website. Or you can actually scan the QR code with your phone. If you scan the QR code, it's actually going to bring up a text message. You just click send, and then you will get the passive investing checklist as well. So if you're either on the call now, you can do it, or you can, if anyone is watching the recording afterwards, you can actually use this QR code and get that passive investing checklist for yourself. So before you're going to invest in an apartment, just go through the checklist. Of course, if you have any question, you can connect with me as well. Even if you're not my investors, I'm very happy to talk to you guys about any kind of investment you're looking at. So that is a brief our fast introduction to multifamily. So I'm happy to take any questions you may have at this point.
Raj, I just want to thank you for your time and all your knowledge and expertise and your willingness to share it with us tonight. It's been so cool to see, your journey because we've been friends for a bit now, and seeing, all these different systems that you've built out as well. Even something as cool as this, a QR code that automatically sends a text message is so neat. So thanks for doing that. I think, you hit on so many awesome points that were super beneficial. I love that you put the sponsor first. And I think that is so important because it's a partnership, with the sponsor that you're investing in. And exactly like you said, folks were able to manipulate numbers and make returns look like whatever they want. And now a lot of those folks are in a lot of trouble as interest rates have gone up, as cap rates have compressed, as NOI has gone down. And so it's been interesting to see that. So thanks for putting that first. I know that you take really great care of your investors, and it's really evident that you're, wanting to form a partnership with them, not just get their money. So thank you for doing that, and thanks for your time. We'll open up the floor if anyone's got any questions.
Okay.